Good morning, dear learners. I, Dr. Abhijit Vishwas, along with my colleague Dr. Shashi Srivastav, are going to offer a course on Essentials of Financial Management. It would be a 8-week course. The first 4 weeks will be covered by me, whereas the remaining 4 weeks will be covered by Dr. Shashi Srivastav. So just have a look at the course outline. We'll start with the concept of finance, where I will discuss about business finance, the traditional view, the modern view, as well as the concept of profit maximization, wealth maximization. The unit 2 will discuss about the concept of capital structure and capitalization. We'll also discuss about what is overcapitalization, what is undercapitalization, what is fair capitalization, and the importance of capital structure. Moving forward, that is the unit number 3 that we will cover in week 3. We will discuss about the theories of capital structure. We have basically 4 theories of capital structure, that is the net income approach, net operating income approach, the traditional approach, and the Modi-Gilani and Miller approach. Apart from this, we will also delve deeper into the concept of arbitrage in the capital structure along with the pecking order theory. The 4th week we will discuss about the concept of leverages, where we will cover the concept of financial leverage, the concept of operating leverage, and the concept of combined leverage. We will also cover the concept of break-even level of EBIT in this unit. In the 5th week, we will discuss the sources of finance, which will include the long-term sources, the medium-term sources, as well as the short-term sources of finance. When we talk about the long-term sources, it includes debentures, bonds, preference shares, equity shares. When we talk about the short-term sources, it includes the money market instruments such as commercial papers, treasury bills. The 6th unit is an important unit where we are going to cover the concept of capital budgeting, which includes the capital budgeting process, the concept of the weighted average cost of capital. Here we use 6 techniques to accept or reject a project. So these 6 techniques have been segregated under 2 broad categories. The first is the discounted cash flow criteria, and the second one is the non-discounted cash flow criteria. When we talk about the discounted cash flow criteria, we have the 4 methods, that is the net present value method, the internal rate of return method, the profitability index method, and the discounted payback period method. When we talk about the non-discounted cash flow criteria, we have 2 methods. One is the payback period method, and the second one is the accounting rate of return method. We will discuss about all these techniques in detail in our 6th week. In the 7th week, we will start with the concept of working capital management. So when we talk about working capital management, we are basically talking about management of 3 things. What are those 3 things? It is management of cash, management of receivables, and management of inventory. We will also look into various techniques of managing all these 3 aspects. The last unit, that is in the 8th week, we will discuss about dividend decisions and how the dividend decisions have an impact on the valuation of a firm. So there are contradictory thoughts as far as the dividend decisions are concerned. One school of thought says that the dividend decisions are important, they are relevant, so they are categorized as relevant theory, and we have Gordon's theory and Walter's theory under this. And the other school of thought says that dividend decisions are not important and they do not have an impact on the valuation, and we have the Modi-Gilani and Miller theory under this. So we'll discuss this in the last week. So after having an idea about this course outline, let's start with the module 1, lecture 1, that is finance function. In this lecture, we are going to cover what is the meaning of business finance, finance function, traditional view of finance, and the modern view of finance. Now, meaning of business finance. What is finance? Finance is the provision of money at the time when it is required. It has also been termed as the lifeblood of an enterprise. Why it is called the lifeblood of an enterprise? Because like without blood, we cannot survive. It is important for the survival of a human being. Similarly, finance is essential for the survival, for the working, for the growth of an organization. Now, what is business finance? Business finance consists of 2 words, business and finance. The process of managing a company's money and the resources to achieve its goals. Now, business finance includes 4 things, that is planning, organizing, directing, and controlling. Whenever we talk about any process, it cannot start without planning. Planning helps us to predict things in a better way, to be prepared about things in a better way. So similarly in business finance, we try to do financial forecast and future investments. So what would be the sales projections and how much amount of money is required? Based on that, we try to get prepared. Next is organizing. So organizing is like tracking the expenses and the revenues. So let's compare to the life of any individual. We get money from our parents. So we try to track our expenses and the money that we get, so that our expenses does not exceed the amount of money that we get. So the same purpose, if you try to track the expenses, we need to organize with the help of the budgets. Next is directing, making decisions whether to invest in new equipment or expand into new markets. So this is a very crucial decision, and it is termed as the investment decisions, and the future growth of a company depends on these kind of decisions. So here we need to decide whether we need to purchase a new equipment so that we can enhance or increase the productivity of our company, or we want to enter into a new market so that we can increase the market share of the company. The last one is controlling, that is monitoring the company's finances. Now all these processes are there, but if we don't control anything, then obviously the expenses are bound to exceed. So we need to see whether we are going on the right track or not. Let's say you have made investment, but you do not consider the return that you are making on that investment, then you will not be able to see whether you are going on the right track or whether you are attaining the objectives that you want to achieve. So we use some controlling techniques such as return on investment to calculate, just to know whether we are doing fairly or not. So the goal of business finance is to ensure that a company has enough money to operate effectively, invest in growth, and achieve its long-term objectives. So the business finance makes sure that the company stays on the track, it operates in an effective manner, it attains the growth that it wants to achieve, and whatever its long-term objectives are there, the company achieves it. So there are three approaches to finance. The first one is providing of funds, the second one is cash, and the third one is raising funds and effective utilization. So the first one sees that like finance is used when we have certain requirements, the provision of funds is what is finance. The second one is we refer having cash, sufficient amount of cash, that is what we look at in terms of finance. And the last one is raising funds and its effective utilization, that is more important. Only raising is not important, how you are going to utilize that money also matters. That is what we talk here. Next is corporate finance, business finance, and financial management. Now corporate finance or corporation finance is being used a lot these days. The major reason for this, that businesses these days operate in the form of corporations, and that is why corporate finance or corporation finance has become more prevalent. It is a subset of business finance, right? So corporation finance, or broadly speaking business finance, can be defined as the activity concerned with the planning, raising, and controlling of funds used in a business. Okay. And financial management, it refers to that part of management activity which is concerned with the planning and controlling of firm's financial resources. The resources are scarce. They are not available in unlimited quantity. Always the demand is more and the supply is less as far as the resources are concerned, and that is why they need to be controlled and they need to be utilized in an effective way. Now financial management helps in, so what it helps? Financial planning and successful promotion of an enterprise. As already discussed in the previous slide, financial planning is very important. If you are planning for something, you are trying to be prepared for uncertainties to an extent. So financial planning and successful promotion of an enterprise can be achieved with the help of financial management. Acquisition of funds and as and when required at a minimum possible cost. So financial management helps in procuring funds. There are multiple sources of getting funds. We can get money from the banks, we can get money from the financial institutions, companies can issue shares, debentures, bonds. So there are multiple sources. So what financial management helps? It helps in getting those funds, the required amount of funds, at a minimum possible cost. Proper use and allocation of funds. Getting money is not sufficient. If we don't put it into profitable revenues, we are not going to get decent returns, and whenever we are getting money from somewhere, we are bound to return it as well. So proper allocation or the usage of funds is also important, which is facilitated by financial management. Taking sound financial decisions. When we talk about sound financial decisions, the objective is to reduce the risk, to manage debt in an effective way and achieve the long-term growth. Because if we increase the proportion of debt in our capital structure, the financial risk increases. So financial management helps in having a delicate balance, having an optimum balance of debt and other securities such as equity in the capital structure. Improving the profitability through financial decisions. So we should take financial decisions in such a way. When we talk about financial decisions, we are basically talking about three types of decisions, that is financing decisions, investment decisions and dividend decisions. So these decisions should aim at increasing the profitability of a concern, increasing the wealth of investors. Companies should take those decisions which will help in increasing the market value of shares, which will increase the dividend payout to the investors. So financial management will help in these aspects. Promoting and mobilizing individual and corporate savings. So financial management motivates individuals and corporates to make savings and channelize these savings into profitable revenues from where they can generate decent amount of return. So next we will move on to the usage of business finance. So a startup company needs to raise money to develop a new product. So what a financial manager will do? For a startup company, a financial manager will ensure that what is the requirement of the funds, from where he is going to get those funds, how those funds would be utilized, and how we are going to generate decent returns or revenues using those funds. A large company is considering acquiring another company. So in this case, the financial manager will ensure that the acquisition is fair. He will evaluate the risk, the potential risk and return associated with that acquisition. And now he also try to find out the way of taking that company. And the third one is, a company is experiencing financial difficulties. So financial manager will try to delve deeper into the cause of that financial difficulty and try to find out a way of that financial difficulty, whether it is restructuring of debt or raising more capital, whatever it is. Effective financial management helps a company to, it helps a company to increase profitability. So we already discussed the financial management, the decisions pertaining to the financing decisions, investment decisions or the dividend decisions, they all aim to increase the profitability of a concern. We try to get the funds at a lowest possible cost, at the optimal cost, and try to increase the returns from those investments. Reduce risk. So all these decisions carry different amounts of risk. If we take more of debt, so obviously we can expect a higher return, but the risk also goes high. So financial decisions, financial management should also ensure that the risk is reduced. Improve cash flow. So when we talk about cash flow, it's about managing the cash inflow and outflow. Whatever money is coming into the business and whatever money is going outside the business, we try to synchronize it. More money should be coming in so that the firm does not face any difficulty in honoring the payments, in paying to the creditors. Make better investment decisions. When we talk about investment decisions, we are primarily emphasizing the capital budgeting decisions, and these are the major decisions because the future prospect of a company depends on the quality investment decisions that you take today. If a company takes good investment decisions, there are very good chances that the company will earn decent return and will grow in the coming years. Grow and expand. Obviously, if it's a startup company, the major objective is to expand, grow, and the financial management will help a company get off the ground. Now let's talk about the finance function, what it is actually. So It is the central nervous system for money. When we talk about any human body, nervous system is responsible for work properly without a proper nervous system. In a similar way, finance function is the nervous system of an organization. Without the optimum level of finance, no company, no organization can work efficiently because it is associated and required at each step. It is responsible for managing all aspects of the company's financial resources, ensuring the organization has the funds it needs to operate, grow, and achieve its goals. Receiving money is not enough, but its utilization is more important. We are always emphasizing that a firm can get money from multiple sources, but until and unless it is put into profitable avenues from where the company can earn decent returns, it's of no use. That is why utilization or investment decisions are very important for an organization, because once you receive money, obviously it's not your money. If a company issues shares, if a company issues debentures, so they are bound to pay interest, they are bound to pay dividends to the shareholders. So it has to be returned also, and you can return only when you take quality decisions and grow that money. Role of finance function. The first one is financial planning and analysis. So when we talk about the finance function, project its cash flows, project its sales for the coming years, and also do analyze the performance of the company. Investment management. When we talk about investment management, we are basically talking about how the company is managing its long-term investment decisions, that is capital budgeting decisions. Funding and capital raising. What are the sources available to the company? Because different sources have different costs. Let's say the company wants to raise money using debt. It will be a cheaper source of fund. Let's say a company wants to raise money using preference shares. It will be slightly expensive as compared to debt. Let's say a company wants to raise money using equity shares. It will be more expensive. So funding and capital raising. Risk management. Different types of sources have different risk associated with them. Equity shares have less risk because the company is not bound to pay dividends. If company has profit, they will pay dividend, whereas the company issues shares and debentures, they are bound to pay interest, and it is a legal obligation. So different risks are associated, and the company should try to manage the risk. It should not have a lot of debt in its capital structure. Importance of finance function. Strategic decision making. So when we talk about the long-term decisions, or the decisions that helps us or facilitates us in achieving the long-term goals of an organization. Resource allocation. We have got the money, now we need to allocate it to various activities. We have decided that organization has different departments. It has the marketing department, sales department, operations department. So allocation of money to different departments and making investments rationally, because funds are limited. Performance measurement. So it talks about whether you are going on a track, whatever the expectations was in terms of the financial performance, whether the company is achieving it or not. So one of the important matrices that we use to evaluate the financial performance of a company is the return on investment. Stakeholder confidence. If a company is following the finance function, confidence among the stakeholders that the company is doing well. Traditional view of finance. So when we talk about traditional, it focused on financial managers' role in acquiring to meet the firm's financial needs. So when we talk about the traditional view of finance, it primarily focuses on raising of funds, and it was considered that usage of funds was beyond the purview of the finance function. What were the key aspects of traditional view? Emphasis on raising funds. So core focus is on securing adequate financing, approaching external sources, and maintain good relationship with external parties. So as we discussed, the major emphasis was on getting financing from external parties, and the finance manager here is more involved with the maintaining good relationships with the external parties such as the bankers, the debenture holders, the financial institutions. External orientation, heavily oriented towards external environment. Significant time spent interacting with external parties and less attention to internal financial management and decision making. So this is externally oriented because less emphasis is given on the internal matters of a business, how you are going to manage the funds and how you are going to make investment. That thing is not given more importance, rather how we are going to deal with the external parties in order to get the funding, that is given more priority. So it is having a external orientation. Event driven approach. So financial decisions under the traditional view are more of a event driven approach, where you get try to raise money in response to some specific events or needs. Financing is sought when new projects requires capital or a company faces financial difficulty. Let's say you have received an order of producing 10,000 shirts and now you require 10 lakh rupees for that. You will be looking for funding because it's a responsive kind of thing, or the firm is facing financial difficulties, it is not able to pay interest on the debentures that they have issued. In that scenario, they will be looking for how we can raise some funding to sort this issue. So it's a reactive approach and not a proactive approach. And in this world, in this cutthroat competition, companies which are not proactive will not be able to do well, right? So reactive approach will not work. The fourth one is limited scope, primarily focus on raising funds and managing short-term financial needs, and less attention to other important aspects of financial management. So we have discussed that this approach emphasizes only on raising funds and it's a short-term approach. It doesn't emphasizes on the long-term aspects, and sometimes the day-to-day activities are also not taken care of under the traditional view of finance. Limitations of traditional view. The first limitation is outsider looking in approach. What it means? Outsider looking in means the major emphasis is on the external things, and what you can do with the funding, how well you can utilize the funding is not being emphasized. Issue of allocation of funds is completely ignored. You are not allocating the funds, it is considered beyond the purview of the finance function. Does not focus on day-to-day problems. Next is modern view of finance. So we have discussed the traditional view of finance, the next is modern view, and there has significant shift from the traditional approach as far as the modern approach is concerned. So this approach emerged in the mid 1950s, and it includes the raising of funds that we had in the traditional view, but it also includes its effective utilization. So this problem was taken care of. Previously we were talking about that utilization of funds, usage of funds is not under the purview of finance function, but under modern view we include the usage of funds or utilization of funds under the purview of finance function. It focuses on maximizing shareholders' value through strategic decision making and efficient resource allocation. So we can say that according to modern view, finance is an integrated and specialized activity, which is concerned with raising of funds and effective utilization of funds, with the objective of maximizing the interest of the stakeholders. So you see, it's a very comprehensive definition of finance, where we are saying that finance is an integrated and specialized activity. Why we say integrated? Because it tries to take into consideration the different departments of an organization, and it is concerned with raising of funds that we have already discussed under the traditional view, but it also adds the dimension of utilization of funds under the modern view, and with an objective to maximize the interest of the stakeholders. So if we include all these things, this is a complete definition of the finance. So let's delve deeper into the modern view of finance. What are the key aspects of modern view? Value maximization. So it tries to emphasize or maximize the value by generating long-term returns for investors, or taking decisions in such a way that the company stock price is increased. For example, let's say a company is making an investment in AI technology. At this moment it might be a very expensive investment, but if we look at the long-term prospects, making investment in AI technology will help the company in making profits in the long run. So from long-term perspective, it's a good decision. Strategic decision making. So when we talk about strategic decision making, we are talking about the three major financial decisions, that is investment decisions, financing decisions and dividend decisions. We'll discuss about these decisions in detail in the upcoming lectures. Internal analysis driven by data, and we use several tools and techniques. So in the modern view of finance, we use different tools and techniques such as the cash flow analysis, fund flow analysis, trend percentages, ratio analysis to find the details and take decisions. Proactive planning, like when we discussed about the traditional view, it was a reactive kind of planning, but here we are looking forward. We are trying to be proactive. We are planning continuously for the requirements of the funds and how we are going to allocate them and tap the available opportunities. Risk management, a company should try to identify the risk. Let's say there might be a risk associated with the changes in the interest rates or the changes in the currency rates. So we can mitigate these kind of risks with the help of various derivatives. And stakeholder focus. So the traditional view only focuses on the shareholders, but here we are talking beyond shareholders. There are other stakeholders in an organization as well, such as the debt holders, we have the bankers, we have the government, we have the employees, we have the consumers. We try to think beyond shareholders and to think of the benefit of various stakeholders. Aims of finance function. So what are the aims of finance function? Acquiring sufficient funds. So when we want to acquire something, so first we need to assess the financial needs of an organization. Without assessing the needs, how we can know how much fund does an organization needs? So first step is to assess the financial needs of an organization. Let's say if the gestation period is long, then use more. What is gestation period first? Let's say it's the time a company takes to reach the break-even point. Break-even point is that point where the company recovers its cost. It's a no profit, no loss kind of zone. So let's say a lot of fixed costs are involved, then the gestation period will be high. So in that case, if a company is having a very long gestation period, the company should use more of equity, because if it uses a lot of debt, so initial period it will not be able to generate returns, so it will find it harder to pay interest to the debenture holders. Proper utilization of funds. Return should be more than cost. So whenever you are having a fund, the main thing that you should ensure is that wherever you are putting your money into, the return should be much higher. At least it should be to that level which is required by the investors. So return should be compared with the cost. Fund should not remain idle. If you are raising fund from somewhere, you need to ensure that you put it to some productive use. If it is lying idle, it's a wastage of fund, because you need to pay cost on that. Increase profitability. Money generates money. So if you have the funding, you have to put it somewhere. If you make investment, you can generate returns. Neither inadequacy of funds, neither wastage of funds. So if you have raised the funds, always analyze the requirement of the funds. If you have more fund than the requirement, that is a case of overcapitalization. And if you have a less fund than requirement, that's a case of undercapitalization. And both have their different limitations. So the optimum level of funding should be there. That is, there should neither be inadequacy of funds, there should neither be wastage of funds. It should be used in an optimal way, because finance is a very scarce resource and its prudent utilization is necessary. Cost of raising funds should be low. If a company wants to increase its profitability, then the cost of raising funds should be low. It should look for those sources of funds on which it has to pay lower cost. So these are the references that you can follow for further reading and building the concept. Thank you so much.